Good morning, everybody, and welcome to this month's webinar. And we are continuing with our journey on IFRS 16. Now, in this month's webinar, we're looking at risk assessment. You'll see in the webinar, I try and cover both angles. So risk assessment from a director perspective, as well as risk assessment questions for management. If we look at the outline of the webinar, we start with a bit of a recap on what is the business problem, or to put it in context. We look at 1 January 2019 as the key date for IFRS 16, or if you've got a 30 June year end, 1 July 2019. We do look at the questions directors should ask, and I think that's a very important thing, that directors should be asking management certain questions at this stage about IFRS 16, the bigger picture questions. And then I believe there are certain risk assessment questions that management should ask, answer, and document. We look at some next steps. And do you need assistance? I'll refer you to a number of recent newsletters, an article that I've written for the AICD, webinars and publications that's available to you. So what is the business problem? Now, I find this really fascinating. I've actually presented to a number of clients over the last few weeks around the business problem. And the more we talk about IFRS 16, the more I realize the problem is not the debits and the credits. It's the business problem. It's the operational problems around the implementation of IFRS 16. So in last month's webinar, I did show you a diagram that we've prepared for private sector entities, where we've said we understand the issue here is to preserve shareholder value. And there is this concern that if an entity has a lot of leases, that there will be a lot of new liabilities on their balance sheet. And what would that do to shareholder value? Also, we know that after the adoption of IFRS 16, there will be a negative impact on profit going forward. And also, it's not an even impact. So we know there's potential downside around IFRS 16. And we've said, listen, for listed entities, the concern is around share price, around ability to declare dividends, continuous disclosure obligations. Often for private entities, it's dividends, but also bank covenants or covenants in financing agreements. And then for public sector entities, it's around accountability for judicious use of public funds. I think the interesting thing that I found over the last couple of weeks, and this is a real new insight to me, was we've been so focused on getting the numbers ready on the date of transition, being 1 January or 1 July. And, do we get the transition journals and numbers right? So the right of use asset, the lease liability. And we did think about the future for, let's say, the next 10 years, but we were looking how these right of use assets and lease liabilities will play out over the next 10 years, focusing on our current right of use assets and liabilities, how that will unwind through depreciation and interest over the next 10 years. And that's important because that's the financial statement impact. That's what you have to disclose in your financial statements. That's the journals you have to process. But the second part, and that is, I would say, the new insight for me in speaking to so many clients over the last month, is that there's a bigger issue around budgeting and forecasting. And to do accurate budgeting and forecasting around the implications of IFRS 16, you don't want to only look at the impact on profit and loss over the next 10 years as a result of existing or current leases on the date of transition. You also need to factor in future leases I'm calling them fictitious leases, but you need to put that in order to get a realistic picture on what the impact on your budget and your forecast will be. For instance, if you've got 1,000 employees and you intend to keep 1,000 employees in the long term, the fact that your lease of your admin building is expiring in 2 years will not be factored into the journals and into the transition journals and future journals. It will only be for 2 years. However, we know from year 3 onwards, we'll need to enter into a new lease because where else are the people going to work from? So there's really two practical angles here. The one is we need to get the numbers right for the date of transition journal entry and for the journal entries after that to unwind the right of use asset through depreciation or to repay the liability, etc. Yes, we have to do that, absolutely, and that will be disclosed in the financials. And that's focusing on current signed leases. But the second part is we have to focus on budgets and forecast. Now, we have found that in particular, if I go to the next slide, this is a big issue for public sector entities because public sector entities get measured against how they've achieved or not achieved or their budget or their forecast. So it's important to get the transition numbers right for financial statement, but it's also important to get the budget and forecast right. We are having a lot of conversations with clients at the moment. It's more or less my full-time job at the moment, talking about BDO Lead that you can see here in the middle, which is our technology solution. And the conversation initially was just about the technology solution, but it's now moved on to much more. It's about this whole process on, do you have the data available? How do we get the data? Do we have all the data for now and future management? Do an assessment of the data, the quality of the data, the reasonableness of the data. Have we documented our judgments? Then we get to BDO Lead. Then we get to potential IFRS advice, and then we get to profit and liability reporting. So that's just maybe an introduction again. Last month, I did flag with you that there are articles in the AFR around the impact on Meyer and Woolworths of the new standard. So, there's a lot of commentary, there's a lot of interest on what will happen on the adoption of IFRS 16. And there's also an article around Wesfarmers and Woolworths liabilities to double under lease accounting. So you can imagine what that will do to shareholder perception, user perception, if you're suddenly doubling your liabilities. So really it's a exercise about communication. How do we communicate to our users that yes, our liabilities are doubled, but we also adding new assets, but just clear communication. And the only, the way we communicate to users, shareholders, are our annual financial statements. So what an obligation on us as accounting professionals to get that disclosures really well and simple, understandable, to get the message across that yes, this accounting standard leads to certain impacts, but it doesn't change our cash flows and it doesn't change our business model. So that's a real communication challenge. Now, 1 January 2019, the clock is ticking down. As you know, IFRS 16 become effective for years beginning on or after 1 January 2019. So if you've got a 31 December year end, 31 December next year, or if it's 30 June 2020. I've just talked about the pressure on shareholder value and the perception on the market if you've got a lot of leases. Therefore, I would imagine that a lot of entities, when they actually do the financial statements for 30 June 2019, will have comprehensive disclosures on what the impact will be 1 year later on adoption. And also when entities do their financial statements for 31 December 2018, that is the opportunity to communicate the future impact of IFRS 16. So although these standards are live 31 December 19, 30 June 2020, I think IFRS 16 is extremely relevant for the 31 December 2018 and 30 June 2019 and even 30 June 2018 financial statements. So that's an important point. The other thing that was really interesting when speaking to a client yesterday, they've asked me, Aletta, is IFRS 16 a situation where we do a lot of work and hours of work and documentation, and in the end, the impact on our financials are limited? They asked that question because I know a lot of clients have gone through extensive work to analyze the impact of IFRS 15. And some of them, and I don't think it will be all, but some of them have commented, we've done a lot of work, a lot of effort, project teams, and in the end, the impact wasn't significant. So is this going to happen again? Now, to be honest, I'm surprised that that's the result of what happened on IFRS 15. If that happened for you, you might have been lucky, because in my experience, there's been big changes. However, forget about IFRS 15 and 9 and what you've experienced there. IFRS 16, the question is as simple as this. Do you have a lot of leases? Are these leases leases of material amounts? As soon as you say, yes, I've got a lot of leases, I can tell you immediately it will be a lot of work with a big impact, especially if you've got long-term leases with a lot of extension options and material amounts obviously involved. So IFRS 16 is unique. It's very simple. When I speak to clients, and whether it's BDO lead or just in general, I just ask one question. How many leases do you have? And then the rest unfolds. So date of initial application is, if you've got a 31 December year end, is 3 months away, 2 months away, just after Christmas. And if you've got a June year end, you've got about 8 months before you have to mandatorily adopt IFRS 16. Now, date of initial application is a big date because at that date, you have to book a right of use asset, a lease liability, and depending on your transitional approach, which we've discussed 2 months ago, there could be an adjustment to retained earnings, opening retained earnings at that date or not, depending on your transitional method. So it's important that we have our ducks in a row by 1 January to make that initial journal, but also we have our ducks in a row on 1 July. I suppose a lot of our clients are quite fixated on getting the journal right on the date of initial application. And that's fantastic. We have to get that right, and it's focused on leases that have commenced by that date. However, I keep on saying, listen, it's about, yes, getting that journal right, doing calculations for that journal, but then my question is, how are you going to manage your lease portfolio from the next day onwards? And that's where we are selling BDO Lead, which is a lease management, lease calculation tool. And also, do you know what the impact on dividends, etc., will be after that date? So I've written an article that was released, I think, 2 weeks ago for the Australian Institute of Company Directors. This is the link to the article. If I look at the date, I said, yeah, there you can see it's an article that was sent out to these directors, but you can just search it on the website or you can use this link. I've recorded a little video, and then I've included there questions directors should be asking. So I've said over recent years, CEOs, CFOs, finance teams have been grappling with the complexities of IFRS 16, and it really now is the time for directors to ask some tough questions. So I think that's important, that directors and as finance teams, that you know what questions they will be asking. So if we go back, I thought I'll flag some of these questions. By the way, that article is written in respect of the 4 new accounting standards. So for for-profits, there's 3 new accounting standards, IFRS 9, 15, 16. And for not-for-profit entities, there's a fourth one, AASB 10, 58. So some overall questions. Now, these are overall questions, but they particularly actually are very, very relevant for IFRS 16. But because they apply to all of them, I've made them overall questions. So it's questions for directors. And the first one is, how could these new accounting standards impact shareholder value? How can we mitigate that potential negative impact on shareholder value? So communication, etc. Would the organization be able to declare dividends? Now, I flagged that when I discuss transition methods. I flag that when I look at budgets and forecasts. So you want to look at, from a budget and forecasting perspective, if I continue to replace my leases because I expect to use the same staff, etc., will I be able to make enough profit every year to continue to declare dividends, and specifically that it's aligned with my current dividend declaration policy? Questions around how would these accounting standards impact profit of the organization in the year of implementation? And then I've added, and thereafter. And by the way, the and thereafter cannot be based just on the current leases on the date of application. The thereafter will also have to look at replacement leases. How do these standards impact your balance sheet position, your assets, liabilities, equity in the year of implementation thereafter? How does it impact current assets, current liabilities, non-current assets, non-current liabilities, net assets, net current assets? So a lot of things to look at. How have we updated and incorporated these new accounting standards into our budgets and forecasts? That's an important thing. Would the organization be able to continue to meet their current bank covenants? Big issue. If there's a potential problem, and we know it now, let's speak to banks and renegotiate bank covenants. Now, I've also been speaking to a number of the big banks, presentations to their risk teams, and I'm saying to them, we are referring clients to you to come and renegotiate bank covenants as a result of IFRS 16 in particular. What are you going to do? Do you understand the impact? So we are trying to do that as well. Should the organization renegotiate bank covenants? What is the impact of IFRS 16 and the new accounting standards on current remuneration structures and incentives to key management personnel and other employees? So if your incentives are based on profit before tax, let's say a percentage of profit before tax, and that is about to go south, is that how we want to remunerate our employees? And if we know profit before tax will now be more volatile as a result of IFRS 16, is that the appropriate measure? Does the organization need to adjust performance hurdles and KPIs of key management personnel and employees? So performance hurdles, also to the way that they interact with share-based payment performance hurdles. Additional overall questions. So how are we going to communicate the immediate and the future impact of these standards to our shareholders and other users? Has the organization performed and documented an impact or a risk assessment in relation to these standards? Do we have documented position papers to support our accounting treatment? I think directors should ask that. Has the organization updated their accounting policy manual to reflect the new requirements? Has the organization obtained independent accounting advice on these standards? Have the auditors of the organization been involved in the discussions and the impact assessment? What research did the organization do on the potential impact of the standards on the organization's industry? So if we got to a certain position, but the rest of the industry got to a different position, I think the directors would like to know that. Has the organization considered their technology needs and required changes to their existing systems and processes? And how can the directors access further information on the requirements' potential implications? So these are overall questions that I believe directors should be asking. When it comes specifically to IFRS 16, I've asked the question whether the organization has decided on an appropriate transitional approach. I ask clients, number one, how many leases do you have? And number two, have you decided on an appropriate transitional approach? And then also, what process did you follow to decide on an appropriate transitional approach? We can't just go for the easiest one. What are the pros and cons of each transitional approach, and are the directors happy with that approach? So what is the impact of the different transitional approaches? I think directors would like to know. So what is the impact on retained earnings at the date of initial application quantified? Lease assets, lease liabilities and right of use assets at the date of initial application, and also profit before tax over the next how many years, depreciation and interest expense. So I think that's important. I think directors from a governance perspective would like to know, does the organization have a register of all these leases? Does the organization have a copy of all their lease agreements? What process did the organization follow to identify all leases, including embedded leases? So organizations have a lot of service contracts with a lot of suppliers. Have we looked at all of those to identify whether there's leases embedded in those service agreements? An important one, how did the organization decide whether it is reasonably certain to exercise lease extension options, termination options, and purchase options included in lease agreements? And then the last one, does the organization have a technology solution to manage leases on an ongoing basis, meaning after the date of initial application? So I think these are all questions that directors would be interested in. So I've tried to start at questions directors ask, more conceptual, high-level governance type questions linked to shareholder value, etc. And I think, directors, there's been a lot of talk about it. Directors know from the media that it's got a potential big impact. Meeting with clients, I know audit committees, chairs of audit committees want to speak to us at the moment about how do we manage this, what is the process, and then part of that, a potential technology solution. If you want to speak to me about the whole process, including or excluding a technology solution, please contact me. If we go on and say, all right, we've dealt with directors and the questions they'll be asking, what about risk assessment questions that management should be asking? Now, I've tried to make a fairly comprehensive list of questions that I believe management should be asking in order to do a risk or an impact assessment. I suppose the very obvious one is, do you have a lot of leases? And now I must say, maybe coming back to BDO lead, from a BDO lead perspective, we have realized that clients that have, less than 100 leases, they don't want to buy BDO lead. By the way, BDO lead is a SaaS solution. It's on the cloud. You get access to the cloud, and it's safely secured in the Canberra data center, Microsoft's Canberra data center. They don't want a cloud solution. They don't want to manage it themselves, because if you go for a cloud solution, we set it up for you. We give you access. We upload your leases through an Excel upload, and thereafter you manage it. You add new leases. You run reports. So a lot of our clients, if they have less than 100 leases, it's still a hassle to manage, still a lot of work, maybe not significant to the organization, but still a lot of work. They're still looking for something, maybe a cheaper alternative. So we have also launched a BDO lead as a managed service. So at the moment, we have clients that have as little as 5 leases that we BDO staff manage it on BDO lead in the cloud for them. We upload their leases. When there's changes, we make it. We run their reports for them, and they pay us a management fee to do that. As soon as it's more than 100 leases, we could continue to do that for you, and it's soft lines. But usually entities that have 700, 1,000 and more leases, they want to manage it themselves, and they get staff and manage it. I think it's important if you're an audit client of BDO, obviously there's a potential conflict of interest or independence issue. If you just contact me and tell me you're an audit client, maybe tell me how many leases and whether it's significant to your business or not, and we can do an assessment at that level. I can speak to your BDO audit partner and see whether it is a possibility that we help you or not. So that's just a little bit on BDO lead. If we talk about risk assessment questions for management, I think a very important question is, are there any service agreements whereby the services provided to the entity rely on the use of assets that are controlled by the entity? So for instance, if you've got there are services that people provide to you. They use assets that are on your premises to provide those services. And therefore, it could be argued that you actually control those assets. They stay on your premises. Um, you've got control over it. Nobody else can use it. So maybe in that service agreement, there's an embedded lease. So that would be a huge risk that people miss embedded leases in service agreements and other agreements. Questions: does the entity have agreements where the entity have the right to control certain assets as a result of the agreement? So I would say from a risk assessment perspective, yes, investigate further. As soon as you answer yes, investigate further. Does the entity have agreements where the entity have sole use of assets or the right to substantially all of the assets? Yes, investigate. Does the entity have agreements where the lessor does not have substantive rights to substitute the identified assets? So this is all around questions around the definition of a lease and the identification of whether you've got a lease or not. Another question: does the entity have agreements where the entity have the ability to direct the use of the identified assets? So it's all about lease identification at this stage. Next one: are the assets within these agreements of low value? Because if they're of low value, you've got a potential practical expedient that you could use to say, yes, I've got a lease, but because it's of low value, I'm not going to book a right of use asset and a lease liability and apply IFRS 16. I'm actually going to treat it as an expense when incurred, or what we currently do. Another way out of it is, are the assets leased for a short term? So less than a 12-month period. If you say yes, again, there's a practical expedient available. It's not mandatory. It's available for you to decide whether you want to use it or not, to not apply IFRS 16. Now, for the short-term one, it is really aimed at genuine short-term leases, so a lease of a vehicle for a few days or a holiday home for a few weeks, etc. It's not aimed at leases where there's a purchase option at the end of the lease, or there's an option to renew at the end of the lease. That's not a genuine short-term lease. If we look at a number of more questions, does the right to use the asset also provide the entity with other services? Are there any service agreements whereby the service provided to the entity rely on the use of assets that are control of the entity? I think that's a repeat of my very first question. It's important, so I've put it in twice just to make sure you all have it. Will the entity elect to apply the practical expedient on transition to grandfather the current IFRS 17 or IFRIC 4 lease classification for all of its contracts? So this one practical expedient is a transitional practical expedient, and it's available for all transitional approaches. And that is, although the identification of a lease is different in IFRS 16 to the current identification of leases in IAS 17 and IFRIC 4, you have the practical expedient on the date of transition to continue to use the lease identification of the previous standards, which is very helpful for transition. But all new leases, you'll have to consider lease identification under IFRS 16. Another important question, does the lease contain one or more extension, purchase, or termination options? Now, that is a piece of information that traditionally entities have not captured in their software systems. That is, or this is information that has to be captured in a new technology solution. And then the next question relates to it. Is the entity reasonably certain to exercise those extension, purchase, or termination options? Because if you're reasonably certain to exercise them, that will impact and have an influence on your calculation of your right of use asset and lease liability at commencement date. So those two questions work together and are very important, and that you can justify to the auditor how you've made that decision and that how you've exercised that judgment. Does the arrangement involve fixed lease payments? Because we know fixed lease payments get captured in the calculation. Also, are there potentially in substance fixed lease payments? So IFRS 16 looking at substance over form, not just fixed, but also in substance fixed lease payments should be part of the calculation. Are the lease payments dependent on an index or a rate? So a CPI index every year. If that is the case, it would not be factored into your calculation of your right of use asset or lease liability on commencement date. However, every time there is a change in this index or rate, you'll have to update and reassess your calculation. And do you know how to do that? On an ongoing basis? Can your technology solution do that on an ongoing basis? Do the lease payments include variable lease payments as well as contingent rental? Because those items are not included in the calculation. They're actually treated as expensed when incurred. Are amounts expected to be payable? Are there any amounts expected to be payable under residual value guarantees? Because that has an impact on the calculation. Is the interest rate implicit in the lease known or readily determinable? Now, I get a lot of questions around the incremental borrowing rate, because if you cannot determine your interest rate implicit in a lease, you have to use your organization's incremental borrowing rate. And a lot of questions, how do we determine that incremental borrowing rate? Because it will have to be the rate to buy a particular asset and finance it for a particular period to get to a comparable rate. So that's a difficult thing, and often we need input from our corporate finance professionals to help us with that rate. Were any direct costs incurred when entering into the lease? Because direct costs traditionally have been expensed when incurred, where now it will have to be capitalized as part of the right of use asset and therefore included into depreciation in future. The next one, the second last bullet point, at the end of the lease term, will costs be incurred to restore or remove the asset? Now, restoration costs. Now, in practice, this has turned out to be a real problem A lot of, under the existing standards, if you know you've got restoration that have to happen at the end of a lease, you had to say debit a leasehold improvement and credit a provision for restoration on day one with a net present value. However, a number of entities haven't necessarily done that, or the estimates have been a little bit of a guesstimate. Therefore, a lot of clients are currently going through a process to do a re-estimation exercise of these provisions to restore. It's also linked to the date that you expect to restore it. So if you've got a lease for 5 years and 2 extension options for 3 years each, do you expect to pay the restoration provision at the end of 5 years, 8 years, or 11 years? And that links back to the earlier question, are you reasonably certain to exercise an extension option? We also ask whether any of the lease payments were made at or before commencement date, because if that is the case, it will not be included in the lease liability, but it will be capitalized into the right of use asset. Were any lease incentives, including rent-free periods, received? Very important to capture that. The start date of a lease could be the 1st of January, but we've got a 6-month rent-free period, and therefore your first payment date is only on 1 July. Therefore, when you do the calculations of the right of use asset and lease liability on 1 January, there's a 6-month period that there's no cash flow, but you still have depreciation and you still have an interest expense. Do we know whether we've had any reassessments? Reassessments are treated in a particular way. Has the entity changed its assessment of the likelihood of exercising extension, purchase, or termination options? Does the lease contain any residual value guarantee? Another big area, and this is not for date of transition, but really ongoing lease management, is to be able to identify whether there's been any lease modifications, and does the modification increase the scope of the lease? So does it add the right to use one or more underlying assets, so an increase or decrease in the scope of a lease, because there's one accounting treatment for that. If there's that increase in the scope, is the additional price that we pay linked to the standalone price? Does the modification decrease the scope? And, if it decreases the scope, is it a partial or a full termination of a lease? Are there termination payments involved? And also, again, the interest rate implicit in the lease. But this question is different to the earlier one. After we've had the modification, do you know what the new interest rate implicit in the lease is? Because if you have a modification, you have to do your calculations based on the new implicit rate, in the new implicit interest rate. There's also a number of questions that I've put here around initial application, because I know there's a lot of work at the moment to get ready for 1 January or 1 July. So the question is, for contracts entered prior to the date of initial application, have we decided whether to use the practical expedient around the identification of leases? Does the entity intend to apply the full retrospective approach on transition? Was the lease previously accounted for as a finance lease? Is the remaining term of the lease as at the date of initial application less than 12 months? Because if that is the case, you don't have to include it into your transition adjustment. Does the entity have a portfolio of similar leases, such as leases with a similar remaining lease term or similar class of underlying asset in a similar economic environment? I suppose maybe a fleet of vehicles that have similar characteristics is one thing I could think of. Is the lease a lease of investment property? And that's important, because if we've got a lease of an investment property, that right of use asset in relation to the investment property, you could fair value and that depends on your accounting policy. The next question is still on transition. The entity could, if they use the modified transitional approach, they've got a choice on how they measure the right of use asset. A modified approach, your lease liability will always be the net present value of all future payments. However, the right of use asset could be one of two things. It could be the right of use asset as if you've booked it way back when, depreciated it to date, or you could just say the lease liability that we've calculated equal the right of use asset plus or minus your accrual under your existing IAS 17. Question, will the entity use or not use hindsight in calculating your right of use asset on transition? That's an important assessment. There's a number of practical expedients that you should consider when you look at the modified approach. So for the full retrospective approach, there's one practical expedient available. For the two modified retrospective approaches, there are 5 practical expedients that you could consider. Another one is, does the entity intend to exclude initial direct costs? That's a practical expedient. Also, another practical expedient, does the entity intend to rely on its previous onerous lease assessment in determining if the right of use assets are impaired on transition? It's a good practical expedient to use. And another at a risk level, has the entity entered into any sale and leaseback transactions as a lessee? So you've sold it and then you've leased it back since the date of initial application, because there's a lot of new rules around that. And if it is the case, are both the sale and leaseback transactions or payments at market rates? Because if they're not at market rates, we need to make certain adjustments. Also, does the entity have any sale and leaseback transactions that exist at the date of initial application? So those are more around sale and leaseback transactions. So you can see I've worked through questions directors should be asking at a high level, but also questions management should ask to identify where are the particular problem areas in your organization so you could investigate further and potentially document your responses to these questions. So next steps, there's a big process. There's a number of things that have to happen in this process. Date of transition is 1 January or 1 July next year. For December and June year ends, it's very close. Clients are really running us off our feet at the moment with requests. We have to get this done, and especially obviously our technology solution that is really helpful. Please contact us if you want to speak about any of those. As I've said last time, our technology solution, you can look online and you can see a demonstration. If you want to look at how it works, what it looks like, and there's a place to inquire and contact me as well. So happy to do that. The other thing, next steps, I would say, do you have copies of all your operating and finance leases? Have you decided on a transitional approach? Do you have all the data? Do you have a technology solution? Do you know how you're going to maintain your leases on an ongoing basis? Are you guys across the technical requirements? Have you done your risk assessment? Have you decided on a response? Do you have a project plan to get this up and running? This is a big exercise to get it done, a lot of work. The transitional approach, I can't overemphasize that. And have you decided whether you need to change your systems and processes? So our monthly webinars, I just quickly looked at all the webinars we've run over the last 2 years around IFRS 16. The next one is in December on problem areas that we've seen. Our November webinar is getting ready for 31 December financial reporting, so all the new standards interpretations. So in December, we look at problem areas. We have previously recorded webinars last year, a few ones around the technical requirements. In September, we looked at transitional methods. This month, we look at risk assessment. And then newsletters, we've got in our accounting news every month. And this is an example, the August accounting news. There's also one in the September accounting news. More or less every accounting news, there's an article on IFRS 16. And as I've shown you last time, we've got a lot of publications available that you could look at. And a fantastic publication that came out of our global office. Unfortunately, I can't take credit for it. If you look at IFRS in practice, IFRS 16 leases that was issued in February this year. It's over 100 pages, but it's got practical, it's 102 pages. This is a beautiful publication. And it really looks at the key criteria. It looks at examples. There's the table of contents, identifying a lease, determining the lease term, recognition and measurement, lessor, sale and leaseback, effective date, transitional methods, illustrative disclosure examples, etc. It's a beautiful, genuinely beautiful publication that I use a lot. It came out of our global office. If you're looking for technical advice, the leaders in the various offices, I'm looking after National, but based in Melbourne, Kevin in Sydney, Wayne in Perth, and Clark in Brisbane. Please feel free to contact me and I can direct you to whoever. Our team is ever expanding. We're up to 18 people, just in Australia and another 4 in New Zealand. I would say most of us are working really hard on IFRS 16 at the moment. All right. Any questions, please send them through. If you want to speak to me about any of this, please contact me. And I'll say thank you very much for joining me for this webinar. Next month, we talk about the latest developments in the accounting world and getting ready for 31 December financial statements. So I hope you enjoy the rest of your day and week. Take care.